Hey investors, welcome back to another episode of the Investing Iguana, the show where we make sense of the crazy world of finance and investing. I'm your host, Iggy, and today we're going to talk about a shocking event that rocked the markets this week, the U.S. credit rating downgrade by Fitch Ratings. What does it mean for the U.S. economy, and more importantly, for your stocks? Well, buckle up, because we're about to find out. But before we dive in, please do me a favor and smash that like button, subscribe to my channel, and turn on the notification bell so you don't miss any of my future videos. And if you have any questions or comments, feel free to leave them below. I love hearing from you guys. Alright, let's get started. So what exactly is a credit rating, and why does it matter? Well, a credit rating is basically a score that reflects how likely a borrower is to repay their debts. It's like a report card for your financial health. The higher the rating, the more trustworthy and reliable the borrower is, and the lower the interest rate they have to pay to borrow money. The lower the rating, the more risky and unreliable the borrower is, and the higher the interest rate they have to pay to borrow money. Credit ratings are issued by independent agencies that evaluate various factors such as debt levels, economic growth, fiscal policies, political stability, and so on. There are three major credit rating agencies in the world: Standard & Poor's, S&P, Moody's, and Fitch Ratings. Each agency has its own scale and methodology, but they all use letters to indicate the quality of the credit rating. For example, AAA is the highest rating possible, followed by AA+, AA, AA-, A+, A, A-, BBB+, BBB, BBB-, and so on. The lower you go down the alphabet, the worse the rating gets. Now, why do credit ratings matter for investors? Well, because they affect the cost of borrowing for governments and corporations. When a government or a corporation wants to raise money from investors, they issue bonds. Bonds are basically IOUs that promise to pay back a certain amount of money plus interest over a period of time. The interest rate on bonds depends on the credit rating of the issuer. The higher the credit rating, the lower the interest rate. The lower the credit rating, the higher the interest rate. This means that credit ratings have a direct impact on the profitability and growth prospects of governments and corporations. If a government or a corporation has a high credit rating, they can borrow money cheaply and invest in projects that generate more income and create more jobs. If a government or a corporation has a low credit rating, they have to borrow money expensively and spend more on interest payments than on productive activities. Credit ratings also affect the demand and supply of bonds in the market. When a credit rating is upgraded, it means that the issuer has become more creditworthy and less risky. This makes their bonds more attractive to investors who are looking for safe and stable returns. As a result, the price of their bonds goes up and their yield goes down. When a credit rating is downgraded, it means that the issuer has become less creditworthy and more risky. This makes their bonds less appealing to investors who are looking for safe and stable returns. As a result, the price of their bonds goes down and their yield goes up. So what happened this week? Well, on Tuesday, Fitch Ratings announced that it had downgraded the U.S. long-term credit rating from AAA to AA+. This was a huge surprise for many investors who had expected Fitch to maintain its AAA rating on the U.S. after S&P had done so in June. Fitch cited several reasons for its decision. 1. The U.S. government's debt-to-GDP ratio has risen from 79% in 2019 to 108% in 2020 and is projected to reach 116% by 2023. 2. The U.S. government's fiscal deficit has widened from 4.6% of GDP in 2019 to 15% in 2020 and is expected to remain above 5% until 2023. 3. The U.S. government's debt ceiling has been suspended until January 2025 after months of political deadlock that threatened to trigger a default. 4. The U.S. government's governance standards have deteriorated over the last 20 years due to partisan polarization and institutional gridlock. Fitch said that these factors have weakened the U.S. government's ability to manage its finances effectively and respond to economic shocks in a timely manner. Fitch also warned that it could further downgrade the U.S. rating if there is no credible plan to reduce the debt burden or if there is another debt ceiling crisis in 2025. How did the markets react? Well, not very well. Global stock markets fell sharply on Wednesday as investors were spooked by Fitch's downgrade. The S&P 500 index dropped by 1.8%, wiping out $600 billion of market value. The Nasdaq Composite Index fell by 2.4%, and the Dow Jones Industrial Average slid by 1.6%. European and Asian markets also suffered losses, with the Stoxx 600 index down by 1.4%, the Nikkei 225 index down by 2.3%, and the Hang Seng index down by 2.5%. On the other hand, U.S. Treasury bonds actually gained in value, as investors sought refuge in the safe haven assets. The yield on the 10-year Treasury note fell by 5 basis points to 4.03%, while the yield on the 2-year Treasury note fell by 3 basis points to 3.12%. The U.S. dollar also held steady against other major currencies, as Fitch's downgrade did not affect its status as the world's reserve currency. So what does this mean for your stocks? Well, it depends on what kind of stocks you own and how long you plan to hold them. If you own U.S. stocks, you might see some short-term volatility and downward pressure on your portfolio, as Fitch's downgrade could dampen investor confidence and consumer spending in the U.S. economy. However, if you have a long-term horizon and a diversified portfolio, you might not need to worry too much, as Fitch's downgrade does not change the fundamental strengths and opportunities of the U.S. economy. The U.S. still has a large and dynamic market, a resilient and innovative private sector, a flexible and adaptable labor force, and a supportive and accommodative monetary policy. If you own foreign stocks, you might see some mixed effects on your portfolio, depending on where your stocks are based and how they are exposed to the U.S. market. If you own stocks from countries that have a higher credit rating than the U.S., such as Switzerland or Germany, you might benefit from their relative safety and stability. If you own stocks from countries that have a lower credit rating than the U.S., such as Brazil or Turkey, you might suffer from their relative riskiness and instability. If you own stocks from countries that have a similar credit rating to the U.S., such as Canada or Australia, you might see little impact from Fitch's downgrade. If you own stocks that have a lot of business or trade with the U.S., such as multinational corporations or exporters, you might see some negative effects on your portfolio, as Fitch's downgrade could hurt their sales and profits in the U.S. market. If you own stocks that have little or no business or trade with the U.S., such as domestic-oriented companies or importers, you might see little or no effects on your portfolio, as Fitch's downgrade could have little or no impact on their operations and performance. So what should you do now? Well, that depends on your personal goals and risk tolerance. If you are a conservative investor who is looking for safety and stability, you might want to reduce your exposure to stocks and increase your exposure to bonds or cash. If you are an aggressive investor who is looking for growth and opportunity, you might want to take advantage of the market dip and buy more stocks at lower prices. If you are a balanced investor who is looking for both safety and growth, you might want to maintain your current asset allocation and rebalance your portfolio periodically. Whatever you decide to do, remember that Fitch's downgrade is not the end of the world. It is just one agency's opinion based on one set of criteria. It does not reflect the true value or potential of your stocks. It does not mean that the U.S. economy is doomed or that your investments are worthless. It does not mean that you should panic or act impulsively. It does mean that you should stay informed and rational and make decisions based on your own research and analysis. And that's it for today's episode of the Investing Iguana. I hope you learned something new and enjoyed this video. If you did, please give it a thumbs up, share it with your friends, and leave a comment below. And if you haven't already, please subscribe to my channel and hit the notification bell so you don't miss any of my future videos. Thank you so much for watching, and I'll see you next time on the Investing Iguana.